I'm still in the gold trade as well. Gold has been pretty sleepy here recently, waiting to see if we can get a break one way or the other. We've got PPI coming out in just a minute and a half or so here. We'll see if that does anything. Yesterday we had CPI, which came in mostly in line with expectations, but core CPI was a little bit soft. So yeah, we'll see if we get anything out of the producer price index. I'm going to pull up FX Street so it will give me the year over year number for this. So if I go economic calendar, I just want to pull up the producer price index. Here it is. So we're looking at the year over year producer price index. We'll see what we get here in just a few minutes, or I'm sorry, just a few seconds. Let's just go here. Yep, we got about 30 seconds to go. I'm going to switch over so we can take a look at everything at the same time. You've got S&P here, or indices over here, dollar, gold, Bitcoin. We've got our breaking news coming in just after this. Dollar is pushing higher into this. We'll see what it looks like in just a second. PPI numbers should drop any second now. Initial reaction on the indices, slightly higher here. Dollar index, a little bit soft on the release. Gold, pretty much flat. Bitcoin, flat. Oil prices down today. Let's see what the numbers were. Okay, so we had 2.6%. Very interesting. So we had the producer price index excluding food and energy year over year. That's the core number, came in at 2.6% compared to a 2.7% read. The month-to-month reading was softer than expected. The year over year number was softer than expected. Cooler inflation than expected. That's the summary from producer price index, and considering the consumer price index yesterday, the core number came in soft, then that is overall going to kind of suggest that inflation is continuing to cool. It may not be cooling substantially faster than people had expected, but I think the big thing for the market itself was, are tariffs going to cause this big bump up in inflation? We just have not really seen that. And with today's number releasing, that's more evidence of soft inflation. 2.3% versus expected 2.5%. That's a soft year-over-year reading for the producer price index to complement yesterday's inflation print from the CPI, which was mixed. I think this leans us in the direction of inflation this week when looking at two out of our three big ones. The three big inflation reads being PCE numbers, which we have not yet gotten, CPI numbers, and PPI numbers. I would say that after today's PPI number, this leans us in the direction of rate cuts, still on par for September. Now, had you gotten a very, very soft CPI yesterday too, then I think you'd probably be potentially seeing a greater probability, not a strong one, but a greater probability that perhaps the July meeting coming up, we could see a rate cut. But with yesterday's CPI number, we didn't see a huge drop in inflation. But with today's producer price index numbers to kind of balance things to the downside in terms of inflation, or tilt things to the downside in terms of the overall look, that's, I think, why you're seeing a drop in the 10-year yield, suggesting that, again, inflation seems to be cooling in line with expectations mostly, and that's a good thing. I think that's also why the stock market, take a look at the Russell, pushing up 1% now today. Very nice. I'm very long the Russell, so I'll take that any day.
Market analysis, free trading courses, edge finder data, and special offers. What do these things all have in common? They're all available for you right now inside of our free Discord. You can click the link down in the description below to join the free Discord today and get access to all of this and more. Stay up to date with all the latest trading information and A1 content. And if you want to upgrade to our Gold VIP Discord that features every single trade that Trader Nick and our other professional analysts take, you can find the links for that in the description as well. So don't wait, go check out the free Discord today.
Cooling inflation is excellent for stocks, right? The stock market wants to see employment stay steady and inflation come down. A Goldilocks environment, if you will. That's always what stocks want. So does crypto, right? Crypto is the coddled baby. It wants the perfect scenario. At least historically, that tends to be the environment where Bitcoin and Ethereum and all those things typically do well, is when the environment is very hospitable, right? So today we've got cooling inflation evidence, which, how does this impact gold? Bullish, but not screamingly bullish. What would be screamingly bullish would be some sort of geopolitical tension, or if the jobs number was terrible and we had, really cooling inflation so the Fed can cut rates aggressively. That would be the bullish scenario for gold. Gold, to me right now, you're talking about an environment that's kind of gone sideways. You got a range bound market here. You had a cooler inflation print. That's exciting for gold, but you had a hot job or a strong jobs number. That's not so exciting for gold. Strong jobs promote security in the economy. Security is not particularly bullish for gold. Security plus cooling inflation, great for stocks. Stocks love that, right? Because you're talking about a good, hospitable environment. If you were to tell me we're going to get rate cuts plus a hospitable environment, the trade would not be gold. The trade would be stocks. If you were to tell me rate cuts plus recession, the story is gold, right? So you want to pay attention to understanding this is not what we've got. We don't have, and this is why, I do have a long position on gold, but it's a really small one, and it's sort of a geopolitical hedge in my portfolio. My long on gold is not a huge conviction trade for me. Maybe it ends up ripping through highs on some sort of blowout in the Middle East again. Let's hope not. But in terms of where am I with gold? Gold is not super attractive to me, because if it was what would make it super attractive would be we had a bad jobs print, PMIs are downside surprising, everything's looking rough, right? But that's not the environment that we're in. So if I come in here and I pull up, if you want to talk about gold, if you want to say, is gold bullish? We would need dollar weakness. Keep this very simple. If you don't have the edge finder, just watch this for a second, and you should consider getting a copy because this tool alone is worth it. The U.S. economic heat map takes a look at all the stuff that we regularly talk about on these streams and videos. For example, the consumer price index that came in yesterday, the producer price index will update shortly, PCE numbers, which I just mentioned, unemployment rate, jobless claims, job openings. Think of this as your pulse check to the U.S. economy at the high level view that the Fed typically looks at. These are the metrics that they often cite. That's why we built this list. This tool looks at all these data points. It shows you, by the way, the latest dated available data that we have in the tool. And most importantly, is the tool will show you the actual data versus the forecast data and giving you a surprise metric here. Then it will also tell you how that surprise, if at all, if there was a surprise, how it impacts our calculus on the US dollar or the stock market. Now, if you're thinking about gold, just reverse this impact. So let's think about this. If we're looking at gold, remember what I just said, we would need a bad jobs print to get us really bullish on gold here. NFP came in really solid, 37,000 jobs ahead of expectations, right? The market expected 110K jobs. We got 147,000 jobs. Unemployment rate ticked lower to 4.1%. It went down. Market participants thought the unemployment rate in the United States was going to go up. It actually went down pretty substantially. So if you're like, oh, I'm super bullish on gold, it's going to go higher, ask yourself, fundamental analysis wise, does the data currently support that? In my opinion, based on our calculations here, would be no. It doesn't support outright huge bullishness because the economy is not flaring huge signs of a recession at this time. Labor data has come in pretty dang strong here recently for the US dollar. Now, I'm not saying that the US dollar is also, the most bullish thing either. Our impact is sort of mixed 50-50. We're at a 58% of our indicators suggesting bullishness for the US dollar. So if you are talking about, is gold super bullish at this time? I would say not really, but then you'd say, well, Nick, you have a long position on. Yes, but it's sort of a hedge. The reason I say that is because I'm very long stocks and indices at this time, based on what I just got done discussing with you, right? I think we have cooling inflation and hot jobs print. The obvious trade for me right now is indices. Long stocks, long indices. That's a trade that I'm in. It's a trade that I'm trailing stops on. I have a basket of stocks that I own. I'm long the Russell 2000. This is the most obvious trade for me right now. And when it comes to trading, I'm not a genius. I just go for the obvious trades. We use fundamental analysis because that's the wind in our sail. And we look for the obvious trades. It doesn't take a genius to recognize, okay, jobs strong, inflation cool, that's good for stocks. Is it good for gold? It's okay for gold. It's not excellent for gold. So is gold the obvious trade? No. Stocks and indices have been the obvious trade for the last few weeks, last few months. You've got nice price action breakouts, strong upward trend, support holding here. Don't overcomplicate it. The edge finder is meant to help keep some guardrails on what we're doing. Right? So NASDAQ still getting a bullish rating. The commitment of traders data, we can also track institutions to see what they're up to. We did see some accumulation of NASDAQ last week. They added significant long contracts, decreased shorts. That was a very bullish week for the NASDAQ. So for me, I said this yesterday, but if I wasn't in any trades on the indices, the trade that I'd be looking for personally would be a retest on the NASDAQ. 22,000 looks really attractive. And that might mean waiting for a minute because there's that's a ways away. But that would be the only trade that I can see set up. Pound dollar. This was a bearish setup. And so let me think about this really quick. So how is on the EcoScore PPI going to impact pound dollar? Well, let's go look at the top setups. And once this updates under, let's take a look and see what pound dollar is. Pound dollar was a bearish reading. It still is. The producer price index year over year with pound dollar. Bearish here for the pound, suggesting, well, once that updates with the US PPI numbers, I think this is going to go neutral, or actually, what was the latest PPI numbers for the UK? We can take a look at that. If I go UK producer price index numbers year over year, we had higher than expected producer price index numbers, which is bullish for the pound. So this will actually turn into a bullish category for pound and softer for US dollar. So that will make me a little less interested in shorting the pound dollar, at least for now. Here's a look at the economic surprise meter across all major currencies. Euro still getting some strong favoritism here. NZD is getting 100% of the indicators suggesting stats came in higher or stronger for the currency than expected. That's really interesting, especially when you compare it with like CAD or Australia. So let's look at that NZD heat map for a second. If we look at the New Zealand dollar, wow, that is a very strong reading here. So what is this telling us? What are we looking at? The New Zealand economic heat map looks at a collection of economic metrics like it does for all the other currencies. And what we see here is that all 1, 2, 3, 4, 5, 6, 7, 8 of our indicators here, all 8 of our economic metrics came in a way that suggested a stronger currency. This is a great example to go through really quick. GDP growth was expected to come in at 0.7% growth. It came in at 0.8%. That's bullish for the New Zealand dollar. Manufacturing PMIs rose to 48.8. It's bullish for the New Zealand dollar. Services PMIs rose to 47.3 from 44.1. It's bullish for the New Zealand dollar. Retail sales were expected to be flat. They came in stronger than that. Bullish for the New Zealand dollar. The CPI report came in higher than expected. Bullish for the New Zealand dollar. PPI came in strong also. Unemployment rate ticked lower. That's bullish for the New Zealand dollar. And employment change strengthened. Bullish for New Zealand dollar.
Let's go currency strength. By the way, today I have a hard stop at 11, so I'm going to try to get through as much as I can. Flow-wise today, New Zealand getting hit pretty hard this morning at 10 a.m. Swiss getting weaker. That's fine. Not a lot of volatility today in currencies. Japanese yen up. Dollar up. Interesting. So Swiss weakest, New Zealand weakest. JPY and dollar getting stronger together. Strange. But that's where we're at for currencies today. Quick peek, SPX is flat, NASDAQ is down, Dow is up slightly, Russell coming back. I mean, Russell was down almost 2% yesterday. It was down like 1.86 or 1.9% yesterday, and now it's back up 0.6. So that's okay. You don't have like perfectly correlated U.S. markets right now. The S&P and the NASDAQ are being dragged up by, NVIDIA was a big pop this week on the H2O chip, but we are fading. I was looking at a summary here for financials. Conclusion. Okay, this is, I looked at, I just did some AI diving here and pulled JP Morgan, Wells Fargo, Citigroup earnings and transcripts and earnings calls to give me a summary of what's happening from, the positives, negatives, the economy, the consumer. And anyway, here's the conclusion. So strong earnings driven by robust consumer banking, investment banking activity, but their forward guidance, which we didn't have last quarter, nobody really talked about anything forward guidance wise. Forward guidance reflects a cautious outlook due to tariff-related uncertainties, potential economic slowdown. JP Morgan is the most optimistic, citing a resilient economy and positive policy developments, while Wells Fargo Citigroup emphasized client caution, macroeconomic risks. The bank's collective view aligns with JP Morgan Research projection of robust but volatile growth in 2025, with a significant recession risk driven by trade policies. That recession risk, by the way, is around 40%. So big investment banks showing about a 40% risk of recession. It was as high as 50 to 60% earlier this year, obviously during all the drama in March and April. Balance between strong fundamentals, external uncertainties, defense or economic outlooks. So anyway, for the most part, it's uncertainty, caution, but resiliency. And as I emphasized yesterday, if the housing market can't crash, if the economy doesn't, if the consumer doesn't crash, if the bond market doesn't crash, if the dollar doesn't crash, those are all ifs, but those all shouldn't just crash fast. And we don't need all of them. This is one of them. It's like that's your stool. You got 4 legs on the stool. If one thing cracks and breaks, everything else comes with it. So what is interesting to me is like right now we are hearing a lot more tariff talk out of Donald Trump. And I don't know if he's just getting brave because we're at all-time highs and he's like, well, clearly we dodged the bullet here. And I'm just going to be, more aggressive on throwing, like, it's kind of like the Oprah Winfrey thing, like you get a tariff and you get a tariff. Look, August 1st is the tariff deadline. I don't know what it looks like. I do know that coming into Liberation Day, the markets were anticipating like an understanding about a 10% blanket tariff across the world. That's what the markets were anticipating. That Liberation Day rollout was nothing of the sorts. So that's why the market reacted so unfavorably, and then clearly the pivot was aggressive, and we're just pause. Let's not talk tariffs for 90 days. How about that? Well, now we're starting to speak back up. Brazil seeing tariffs, copper sees tariffs, pharmaceuticals, starting low and maybe up to 200%. So I saw this morning on Pfizer. What the heck? So it's like nobody's safe. It's like, is it just like sector by sector by sector, just just picking them off? And once you have like the tariff crosshairs on you, can you survive it? And then it's like you don't have to worry about it anymore. So anyway, again, it just creates a lot of uncertainty, right? So what does that all mean? I just think we have a correction. The big question is a pullback going to see a dip, or a pullback going to see way more of a correction that is like, okay, well, the Qs have ripped up 30+%. Is this market going to be pulling back into something like equilibrium? Maybe we don't take out the April lows again, but we pull back into a level like everything I've been talking about. How about this giant 3, 4, 5% US-China trade agreement gap? That to me would be a nice equilibrium for price to find, and then figure out where do we go from here. Like the reality is, are we going up or down from maybe pulling back to it? And I know that getting there is not going to be easy, and I know getting there is not going to be fun. If we get there, it's not going to feel good. I can promise you that it's not going to get there like, oh, just a little smooth 5 and 10% correction. That doesn't happen. Not in today's market. So how we get there could be really nasty, really violent, but just have the courage to buy good levels, have the courage to position some trades. Hopefully with a spike up in volatility, that gives us a good chance to be premium sellers and sell those expected moves, which are going to be greater than the actuals. That's how we make some good money. Okay, Myra 0 DTE pattern day trader rule. That's on a margin account. Yep, but there's workarounds. It's easy. I do it with members every single day. I've got members that have 2 small accounts, right? Small account here with Interactive Brokers, small account here with Tasty Trade, Thinkorswim, E-Trade, Fidelity. So 2 brokers, small accounts. You can trade 2 days a week and 3 days a week. No pattern day trading, right? That's a workaround. You can also trade futures. You can trade ES, MES. You can trade futures. There's no pattern day trading in futures. So for futures options permission. So not hard. And also I wouldn't be surprised from, some of the connections I have with CBOE and Tasty that I know that they're pushing hard to try to get some of that additional, trader love out there where there will be no more pattern day trading, because I think the US is the only country that does it. I don't think Canada has pattern day trading rules. Europe doesn't have pattern day trading rules. Asia doesn't have pattern day trading rules. Their margins are different. Their leverage is different. But pattern day trading, I think, is only in the US, and it's only on margin accounts. So hopefully that's something that goes away. It's like trading has been very retail trader friendly the last few years. 0 commissions, very low fees, like entry only. Like I pay entry only commissions on my options. So hopefully that stuff goes away. It'd be nice. But yeah, or you can just have a cash account. Cash account, you always have enough cash. I mean, buying power for the trades I do is anywhere between like $500 and $2,000. So if I have enough cash to cover that trade and trade it every single day, there's no pattern day trading. Your only options Interactive Brokers. Gotcha. So you literally have no other broker. That's okay. I mean, you still get 3 days a week. And if you're in my class, we've kind of narrowed down like the ideal trading days to Mondays and Wednesdays. So, I mean, if push comes to shove, if you're worried about the pattern day trading, Mondays, Wednesdays are, to me, data-wise, the 2 best days to do it over the last 3 years. That's what we've shown. So, I mean, there's definitely workarounds. Okay. All right. So let's go a little top down here. SPX. Yesterday's candle kind of put in a bit of a shakeout around 6,300. Right now, if we zoom in, 6,300, 6,200. That to me is this little narrow level that, and I don't think we break too much higher than 63. I think this kind of puts in a bit of a range play. Going back here on this price action, I mean, I don't think I'd be terribly surprised to see this is the resistance area, and intermediately we have about a 6240 support and a 6200 support. So I'll make this a little bit smaller, but if we see price dancing around in here, obviously this is just a bunch of noise. So this is all noise. If we break below 62, That's when things get a little bit more quick to the downside, probably heading towards 6,000 or lower. But this is the hard part about timing the market. I don't know if this market's going to do it today, do it tomorrow, do it in a week or two. I don't know. I don't care. But I do know that if we get below 6,200 with some conviction, that's the best time to appropriately bearish. So an example would be if we break below 6,200, every day I come to the market, I could probably do a bear call spread and have a chance to do pretty well, right? If we're going to break down and go lower, we might gap lower, we might head lower, we might intraday price action go lower, but bear call spreads could be great down to 6,000 or lower. But if we don't break that 6,200, all I'm doing is guessing and wanting and begging the market to go down when it doesn't want to budge. So don't force trades, especially based on time. It's like until price proves some confirmation, don't force the trades, right? But when price finally proves a break below 62 with some conviction, then yeah, I can focus on maybe opening up the floodgates for like 200 to 300, 400 points down. And that's fine. It's not the end of the world. Like it's literally like a 5% correction. But to do that, you might have some direction. And that could be, 0 day every day the market's down. That's rare. But usually it's going to be the market's going to try to gap lower. Okay. So if we did like a week expiration or a 1 or 2 day expiration, just try to get the traction to head that way. Make sense? All right. I'm going up. So Ken on dollar Swiss, I'm looking at like 85 to 8,600 on dollar Swiss. That's where I'd like to take some profit on that currency. Okay. All right. Like I said, I got about 25 minutes where I have to stop. So let's do some more top down. Currency strength, interesting flows. Japanese yen a little bit stronger, not a ton of volatility. Swiss weakest, New Zealand also joining, which I think is kind of interesting to get that. New Zealand's coming out of nowhere. Aussie also dropping a little bit, but it's mainly yen up, dollar up, and then the pound was kind of strong all morning. But New Zealand, look at this, strongest overnight, now one of the weakest. Volatility. Right now, NASDAQ is clinging to a flat day, 0.07. Qs are down slightly. Dow is up and Russell is up a little bit. Okay, volatility index up over 17. Let's go dollar index. Again, maintaining a bid. Daily time frame, lots of candles on the way up. I still think this has a, bid, maybe a pullback, maybe a bid, maybe like a little 3-wave move to get this thing back up. I keep saying like 101 to 102. So am I really long the dollar? No, I'm not really long the dollar. I'm just saying don't sell, don't short the dollar. So I saw the euro dollar was down like 60, 70, 80 points. That's fine. Like this is the inverse of euro dollar pretty much. Oil, 65 support for now. I'm hearing rumblings of OPEC cuts coming in August. So that might keep the floor in around 65. But I have a futures trade on down to $50, not 55, $50. So I'm giving myself a little bit more wiggle room for price to maybe fall, but still offer a couple $100 in oil. That wasn't out super far. I think I went out to December to see if oil just stays somewhat resilient. Natural gas, 1574. I have a covered call at 16. That's part of my diagonal spread. I guess it's just a sell call, my diagonal spread. Gold, not much happening here. Not too exciting. I still think gold has to find a 144 to 200 moving average this year. I'd be shocked if it didn't, but I think we're just going to go sideways for a while. Silver, pullback. If we pull back to $36, it's still very well supported. If we pull back and this becomes kind of a nasty pullback, it's still very well supported. The deeper we pull back into here, or if you have a price where it closes below the 200, then closes back above, closes below, closes back above, to me that's a great spot to get long. So I'm still long on silver until about $48. That's my price target. I'm gonna hold silver for a while, okay? But if we pull back to a 50-day or 100-day or even this 200-day, if we pull back and go back above, I'm going to add more exposure, probably a silver futures trade, probably adding some SLV, probably some naked puts, honestly, and just see if that level holds and gets back up into highs again. I don't know if it's going to pull back that deeply, though. This was a pretty convincing breakout. That breakout there we just have good levels. The 21's a little aggressive. The 50 to 100, I think we could find some support.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.